Welcome to the Long-Term Investor. Today, I am joined by Robin Powell, award-winning journalist, and also runs one of my favorite websites, The Evidence-Based Investor. Robin, thank you so much for joining me.
Well, thank you so much for having me. It's a real pleasure to be on.
Well, Robin, you have a very long career in journalism in general, but I'm kind of curious just to start us off, what drew you to the world of finance?
Well, yeah, I mean, I was a jack of all trades journalist, if you like, for many years. I was mainly in television and reported on all sorts of things, including a couple of wars, Yugoslavia, the first war that I was involved in, although thankfully not ever too close to the kind of front line, if you like. I was in Iraq as well, filmed really all over the world. But it was only when I actually left mainstream television news and set up my own production company that I really got interested in finance. I suppose I'd been a sort of armchair amateur enthusiast, if you like. I kind of read the financial sections in the weekend papers here in the UK and fancied myself as a bit of an expert. But of course, it was only really when I started to look into this subject in any detail, I realised I knew absolutely nothing. That's really how it all began.
It's funny. The more I learn, the more I feel like I know absolutely nothing. But Robin, the first time that we met face to face was early on in my career at Plancorp. You were in the US doing a bit of a tour, and I had already been reading your website, The Evidence-Based Investor, for quite some time. So even though you might have felt like a relative amateur, I remember feeling like I met a celebrity that day that you were in our offices. So it's really a treat to be talking to you. And I think your objective point of view is what has always been such a draw for me. And so I guess let me start with The Evidence-Based Investor. What you name your website after that. What does that even mean? What is evidence-based investing?
Well, I suppose this all started when I made a documentary back in 2011 for a wealth management firm in the UK called Barnett Ravenscroft Wealth Management, and they had this passive investing portfolio, broadly speaking, and they said, look, we work with very wealthy people, but we want to be able to explain to everyone the benefits of low cost indexing, if you like, because we feel that this is the way to go. And I'll be honest, I was quite sort of skeptical about passive investing in those days, but I thought, well, it's an interesting project, I started to sort of read up about it and interviewed some key people in the asset management industry and in academic finance. I came to the US to interview Jack Bogle and various other sort of key people in the industry. David Booth from Dimensional, William Sharp, the Nobel prize-winning economist. And I'll be honest, Peter, I was blown away that there is all this evidence out there about how people should be investing. And yet we have, it seems, kind of a whole industry, the fund industry, aided and abetted in many cases by people who should know better, financial advisors and investment consultants who are actually trying to get people to do the very opposite of what they should be doing. So I don't actually find that kind of distinction between active and passive investing particularly helpful. I prefer to talk about evidence-based investing, and I suppose how do I define it? It's evidence based on data. It's investing based on data that shows that it works over time, and lot of people, when they first hear about evidence-based investing, they think, wow, that's strange. I mean, you would have thought that it is evidence-based, but actually, it's not. It's not in the same way as, for example, we have evidence-based medicine, which people are familiar with. Actually, a lot of investment decisions are based on opinions and hunches, instead of on data and evidence. And the evidence-based investor is all about explaining what academic finance experts have discovered over the last sort of 50, 60, 70 years that they've been doing this. It's a relatively new academic discipline. And I suppose there are sort of 3 or 4 sort of key elements. One is that it's academic, and therefore it's peer reviewed. So you can't just write a paper and say, I think investing in, I don't know, the steel industry in the Far East is the way to go, or whatever. The beauty of peer review is that you have other very, very intelligent people who are checking what you're writing and saying and challenging that. So that's the first thing. The second thing, I think, is something that is time tested. Something can work over 1 year or 2 years, but actually, when you're an investor and you're investing for, I don't know, 40, 50 years, 60 years, children today or young people today will be investing for a lot longer than, our parents or grandparents, for example. You want to base it on something that's been shown to work over, 100 years, preferably. And I suppose another aspect would be that it's based on robust analysis. And frankly, not enough analysis is robust. Largely because a lot of the research on finance and investing and fund management and so on is actually produced by people who want you to draw a particular conclusion. So they point you towards the conclusion that they want you to agree on. Those, I suppose, are the key elements of evidence-based investing.
So many interesting things that you said there, Robin. I think it's, for someone like me, it's easy to take for granted the idea that evidence is data and not stories, because even anybody in marketing and advertising is so good at getting us as consumers, not just of investments, but of any kind of good or service, to connect with a story and understand our primal urges. And that's how they sell to us online, on video like we are, or on podcast. And I think, the peer-reviewed piece is really important, and working in and out of data samples and long-term time-tested approaches, but this robust piece where there is a lot of conflict on Wall Street, and people can sound brilliant and point you in the right direction of a strategy that both can appeal to your data-driven, thoughtful part of the mind, but also appeal to that story piece of the mind. And I think that's what makes it so difficult for so many people to delineate what is good evidence and what is just story. What is, numbers are not always actual data. Sometimes numbers are story.
You've absolutely hit the nail on the head. Storytelling is how human beings from, the very earliest humans have actually communicated with one another. It's how we express opinions and come to conclusions about things. They are extremely powerful. It's interesting for me coming at the fund management and investing industry, if you like, as a journalist, because I sort of, that's my stock in trade, stories. So I understand the power of stories. And, I think my own profession, journalism, has actually been partly responsible, if you like, for a lot of the misapprehensions and misunderstandings about how investing actually works. The reason being that journalists, to sell their newspapers or magazines or online subscriptions or whatever it is. And crucially, to attract advertisers, they need to tell compelling stories. You can't sell an investment magazine on the basis of, you should buy index funds, you should invest for the long term, and that's it. It's like having a slimming magazine that says, you need to exercise more and eat less. You can't keep on saying it every week. There's this constant need for stories, and we're all suckers for stories. Not just investors either. I've actually been spending a really fascinating morning reading some new research, actually, by a researcher in the US and 2 in the UK, who interviewed 69 fund managers about fund management and what they thought about active fund management, whether or not they were worried about the rise of passive investing, for example. And what these fund managers do is they tell themselves these stories to help resolve, if you like, this cognitive dissonance that's going on, that help them to justify charging the fees that they do, that make them get out of bed in the morning when they know that, there's a 95% chance that over the long term they're not going to beat the market, for example. So it's not just investors who are suckers for stories. It's actually professionals, financial professionals themselves, fund managers, financial advisors, investment consultants. So you're right. Stories are extremely powerful.
Robin, what's so interesting about that last bit that you shared, and by the way, I'm going to have to touch base with you offline to find that paper. And for all those listening, I'll put it in the show notes at thelongterminvestor.com. Sure. But I think that when I started my career, I started in June 2007, and indexing was gaining popularity rapidly after the great financial crisis. But it was already, the movement was already in progress by that point. And I remember thinking I was running into so many advisors over the age of 50 who had staked their entire careers on this idea of active management, and the stories that they would tell in rooms, whether it's in charitable investment committees or at networking events, sounded like stories like you're describing, where they had to sort of create this story in their mind on what they were doing was okay, despite the fact that the data very clearly showed otherwise. And the other thing that's really interesting that you talk about is just this idea that, look, a journalist, the media, they have to sell magazines, they have to sell advertisements, they have to have you tuning in. And so good advice does not change that much in the investment realm, but you can't just air the same thing over and over and over and put it in print. The one core concept I think that we don't hear that much about is, while we talk a lot about the different investments, the part of investing that is about having a plan seems so important. And Robin, as you've gone on your learning journey and published across all sorts of mediums, I'm kind of curious to get your thoughts on how you feel the role of a plan plays within all of this.
Well, the old adage, you fail to plan and you plan to fail, I think is really relevant here. I'll be honest, I'm sort of in my career, I've over the last 10, 12 years, I've been really writing about the kind of investing piece. And to me, important though that is, and getting the message across to people about what works in investing and what doesn't, and how what you often read about or what you often hear advisors say isn't actually what you need to hear. I've actually realized that more fundamental than that, more important than that, is this idea of having a plan, it goes without saying that our time on Earth is relatively short. There's actually a really good book that I've been reading called 4,000 Weeks by a guy called Oliver Burkeman, and 4,000 weeks actually is a typical human lifespan in the Western world. And when it's put like that, it's actually not very long. It's funny, we go through our life very often denying that the end is coming, if you like, and that we only have limited time to do everything that we want to do. And it's actually just relatively few of us who sit down and think, well, what are my values? What are my goals? And what do I want to achieve with the rest of my life? Who do I want to spend that time with? That's why it's so important that you have a plan, because without a plan, an investment portfolio is just meaningless. It's just a bunch of investments. So the plan really does, or really should, come first.
The common example I always hear people give is if you walked into a doctor's office and the doctor immediately wrote you a prescription before you said a word. That would be sort of the equivalent of being handed a portfolio before you figure out your goals and values. And once you do go through the process of the financial plan, then you can match it to your investment strategy. Do you agree?
Exactly. I mean, I too, I love that analogy. And, I mentioned evidence-based medicine earlier. And actually, if you read the history of medicine, it's actually quite interesting that it hasn't always been evidence-based. And actually, a lot of what became accepted wisdom was really just opinion and the way things had always been done. And it was only with the advent of clinical trials, the importance of evidence in medicine really started to emerge. The medical profession has greatly improved, over the centuries. I think, I'm an optimist. There's a lot that's wrong with the investing industry and with the financial advice profession, but I actually am a kind of long-term optimist when it comes to the finance industry. I think things are moving in the right direction, and actually financial advice is moving in the right direction. And it's not just about providing solutions. It's not just about selling products. It's about really getting to know the client and working out what the issues are and what you need to do to get you from the point where you are now, point A, to point B, in the easiest and most efficient way, if you like. So yeah, I really do think that in a sense, that they're almost converging, those two professions. The sort of medical profession and the financial profession. I think it's just really, really important, because medical advances have actually enabled us now to live much longer than our ancestors did, and young people today increasingly are going to be living, into their 90s, beyond 100, and so on. And finance has got to keep up with this, because that's a long time that people are going to be spending in retirement. And so the same kind of evidence-based approach, which is prolonging people's natural lifespan, if you like, needs also to be applied to investing and retirement planning, to make sure that people actually have enough money to last them for the rest of their lives.
Robin, this may be a silly question, and for those of us listening, they're probably picking up on the fact that you're not a native American. You're not native to the U.S. You are from the U.K. And again, maybe a silly question, but you work obviously with a lot of U.S. investors. Are there differences in being an investor in the UK or outside the US? or is it largely the same?
People over here say, well, what happens in America almost invariably happens over here about sort of 10 or 20 years later. And, in lots of aspects of life, that is true. Not always true, but actually in investing, that is largely true. That, what you experienced in the US, we are going through the same thing now. I have a great admiration for Jack Bogle and everything that he did for the investing industry and investors generally. But in America, it took a long time for his philosophy to take hold, if you like. When he first introduced index funds for retail investors in the mid 1970s, he was absolutely slated, and it took many years for them to prove their worth, if you like. And even today, there are still many advisors in the US who are still recommending, expensive, opinion-based, actively managed strategies. In the UK, we are much further behind. We are catching up, and in fact, I think the pace of change is sort of slightly quicker than it was in the US, particularly in recent years. We had a big scandal here. A famous fund manager called Neil Woodford. His fund spectacularly blew up, and that led people to kind of question active fund management and the value that active fund managers provide. We've also seen the regulator here, the Financial Conduct Authority, insist that the fund management industry demonstrates its value to investors. So we are really starting to see change here, and this massive exodus from active funds into index funds, but we're still far behind the US. And I tell you what, Peter, there are some other countries that are further behind still. Australia a little bit behind the UK, but again starting to sort of pick up. There was something there called the Royal Commission into the banking industry in Australia about 3 years ago now, and it showed massive kind of sort of bad practice and wrongdoing in the investment management industry, and gradually things are starting to improve. But again, Australia is probably behind the UK, and then you've got other countries in Europe. The Netherlands seems to be quite on it. Its regulator is really working hard to raise standards. But other than the UK and the Netherlands, the investment landscape is absolutely dominated by the big banks. I mean, France is a big example of that, and Mediterranean countries as well. Italy, Spain, Portugal. Really active management, really very much still does rule the roost. I actually was contacted by a reader of my blog, The Evidence-Based Investor, in the Canary Islands the other day, saying, can you recommend an evidence-based advisor? And I like to put people in touch with someone who I think can really help them achieve better outcomes. But I said, I'm sorry, I've drawn a complete blank. Not only do I not know an evidence-based advisor in the Canaries, I don't know one in Spain. I actually managed eventually to find someone in Barcelona who might be able to help him. But the rest of the world really is behind the US in terms of improving investment outcomes through efficient, low-cost index investing, and through proper financial planning. Financial advice is very much in large swathes of Europe just flogging investment products, if you like.
That's really fascinating. I had no idea. I've never perceived the U.S. being so far ahead on some of these investment styles and philosophies, and to your point, the planning. And I think some of that is PlanCorp is part of an association that I think you're familiar with, the Global Association of Independent Advisors. And so a little of my global view is skewed by our participation in Gaia and in hearing what some of those firms do. So I think that's fascinating to hear your perspective there. And you also mentioned Neil Woodford. For those who don't know that name, he's largely considered to be the UK's Warren Buffett, so to speak. Just because you mentioned that scandal, I'd love for you to give listeners, viewers, a little bit of background on what happened there. And then maybe we can talk a little bit about the consequences or the implications of it all.
Yeah. Well, it's funny, Peter, because over the years, a number of people have been referred to, or more likely referred to themselves as, Britain's answer to Warren Buffett. But a lot of them have just sort of gone by the wayside. I can barely remember some of their names myself now. And let's face it, even Buffett himself has kind of struggled to beat the index, certainly since the global financial crisis. Neil Woodford was the kind of poster boy for the UK active fund management industry, a very kind of photogenic guy who had a very successful career with a company called Invesco Perpetual, and he made some big bets. For example, he liked traditional firms like tobacco manufacturers, which for many good reasons fell out of favor in the kind of 90s and so on, and he stuck with them, and he also avoided banks before the global financial crisis. He also avoided tech stocks largely before the tech bubble burst, if you like, at the end of the 20th century. So he made some good decisions. Or I would actually say, made some good bets that paid off, if you like, and they developed this kind of aura of invincibility around this guy. People thought that he was a genius because when things go right, we always like to attribute our success to genius, and when things go wrong, we always like to suggest that it was someone else's fault, or that it was circumstances or whatever else. He set up on his own in 2016, I believe. He set up his own fund management company, and he, I think, started to believe his own publicity. So he just felt that he was invincible. He placed some very kind of extreme bets. So he loaded up on very, very small companies, unlisted companies as well, everyone just thought, well, because he's Neil Woodford, because he's a genius, let's just leave him to it. And his fund performance went down and down and down over many, many years. And eventually, one of the big institutional investors, a big council, local authority here called Kent County Council, they actually wanted their money out. And when that happened, it's kind of sort of sparked a crisis and a rush for the exits, and they had to suspend the fund. This guy, who had been fated as a genius, He's got an MBE. He's part of the kind of British establishment, if you like. People suddenly realised that he had feet of clay, and I think it's important for people in the other countries to read about these, because every country has these people, these stars, if you like. I also write for an Australian financial planning firm, and they have people like this over there as well. People who people thought were invincible, who messed up spectacularly and lost their clients lots of money. So we really do have to learn the lesson here. This failure of active fund management, it's not just a US phenomenon. It's very, very much a global phenomenon.
Well, what I found so interesting about the Neil Woodford story is once people started rushing for the gates, then they started to see some of the funky accounting that he was doing. And here's somebody who had a decorated career. And I think this idea of a star manager is almost impossible to maintain these days, because when you have good performance as a result of, as you called it, I think accurately, a couple good bets. I mean, if we were to line up 10,000 people and let them flip coins for their whole lives, eventually somebody's going to flip 100 heads in a row. It's just an odds thing. And yet money flows to these people and they can't necessarily replicate the bets. It gets harder and harder to deliver. And I think our ego gets involved with anything that we, I think, do professionally. And someone who is truly a star has risen to a level where they're trying to do what they can. And people flood to the gates. And in this case, I think he had a lot of unlisted stocks, if I remember correctly, where, he was moving some monies around that weren't quite correct either or legal. So I think it highlighting a lot of the challenges with active management. And I appreciate you giving the example in the first place, because yes, in the US, I'm always thinking of Bernie Madoff, and maybe nowadays I'll start referring to Sam Bankman-Fried as well. But everybody having these types of people, but it all comes back in my mind to the idea that it's just really difficult. If we don't want to say impossible, it's very, very, very difficult to just beat the market overall. You had a series that I remember watching during the pandemic called Index Funds, the 12-Step Recovery Program for Active Investors. I think just to close us out here, I would love if you could share some of the key ideas, and you don't have to necessarily run through everything if you don't want to, but just what really the messages there are for people who are starting to introduce themselves to this idea that there might be a better way to do it.
Yes, that series of videos I produced for an advisor in California, and really what we wanted to do there was to explain how active funds, you can overplay this a little bit, but how they've almost kind of become an addiction. We're addicted to the excitement aspect of investing. We're addicted to that, gambling, that speculating, if you like. And I think there is that in all of us. Jack Bogle, going back to Bogle again, said, okay, if you want to mess around with 5% of your portfolio or whatever, I think you call it funny money. If you want to take a punt on something, do it. But for goodness sake, safeguard the core of your portfolio, the bulk of your portfolio. Make sure that is sensibly invested. So that series is really about explaining the benefits of diversifying, and not putting all your eggs in one basket. In fact, doing the very opposite, and actually having a portfolio that's exposed to different asset classes in different geographical sectors, different economic sectors, and just basically having lots and lots of stocks in there, as well as bonds as well, or cash if you want it in there too. That's a very key message of it. The other is just long-term investing, and not worrying about the kind of ups and downs of the stock market, because that is what stock markets do. They just go up and down on a daily basis. And if you can avoid it as much as possible, just don't check the latest S&P 500 figures, for example, or FTSE 100 or whatever it is, and just ignore it. Go about your everyday life. That's a much better approach. And I suppose the third key thing that we looked at in that series was the importance of behavior and being disciplined and being aware of the fact that human beings don't make very good investors, that we are hardwired, if you like, to make the wrong decisions. So in a sense, the best thing you can do is to make as few decisions as you can, and if possible, just to automate everything. So the decisions are kind of, you've already made the decision. So they're just, your money goes out every month into your investment account, that you've got a fixed portfolio allocation, and that your allocation is rebalanced every, whatever it is. I think in the US, for tax reasons, I think you rebalance a bit more often than we do here in the UK. Here, I suggest people rebalance maybe once a year, and might be advantageous in the US. I understand. I'm sure you know more about this than I do, Peter. Possibly to rebalance more than that, but more or less to put as much as you can on autopilot. They're really the key messages of that series.
Well, Robin, this has been a treat for me. And I know that I've mentioned several times the evidence-based investor that we will definitely link to in the show notes. If listeners, viewers want to find you elsewhere, where can they find you?
Right. Okay. Well, the blog, the domain is evidenceinvestor.com. I'm on Twitter at Robin J. Powell, at Robin J. Powell. I'm on LinkedIn as well. It'd be great to connect with people who are interested in evidence-based investing and good financial planning.
You're a great person to follow because you're always putting out useful, objective information. So again, Robin, thanks so much for joining me. And for all of those listening, please be sure to like and subscribe wherever you are watching this. If you're on YouTube, leave us some comments. That is always helpful for me to figure out what it is that you want to hear about next from us. So Robin, again, thanks so much. And to all of you watching, listening, to long-term investing.